Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I had a question about borrowing to invest and investing on margin. So, borrowing to invest multiplies your gains and losses. So, for example, if you make 5,000 off of 10,000, the return is 50%. But if you use the 10,000 and you borrow 100,000, so now you're 10 to 1, and you make 50,000, you actually made 500% off your initial 10,000 as long as you're able to pay the interest, which comes out of your gains. Note that losses are multiplied as well, however. This multiplier is called leverage, and it's like fire. It could be good or it could be bad. So, just whether you want to borrow to invest in the first place depends on a couple of things. Number one, you're okay and comfortable with debt in general. A good number of people see debt as something to pay off and get rid of, which isn't a bad way of thinking about it. I know you can use debt to make more money, which is the definition of quote unquote good debt, and everyone needs to decide for themselves. The second thing is, can you pay the interest? So, whenever I'm borrowing to invest, I'm at least buying stocks that are paying dividends that cover the interest. That's my own personal approach. Number three is you have an exit strategy to pay the debt off, whether the investments go up or not. And fourthly, you believe the returns will beat, at the very least, the interest you'll be out of pocket. Now, to buy a house, you usually use a mortgage. Very few people buy a house for cash since houses are so expensive. It would take a long time to get the cash together, and you want to live in a house. To buy more stocks than one has cash for, you can use your stock assets as collateral to get more money to buy more stock while paying interest on the borrowed money. Because stocks are more volatile than real estate, there's a bit more complexity to it. And this borrowing is called using a margin. Now, to do options trading, you definitely need a margin account. My put selling, which I have a video for in the upper right, is using a margin account, and it allows me to not spend any money, because if the stock goes up, the put that I sold expires worthless, and I made money, the premium, right up front, off of zero investment and zero cash, which is quite nice. I have margin in two brokerages. Qtrade has rules as far as how much margin they will give me. My buying power is about 60% of my stocks. Their interest rate is roughly 7%. For comparison, my home equity line of credit charges me 5.95%, so a little bit lower. Interactive Brokers has a totally different set of rules for how much credit they will give you, but it's either 0, 30, or 50% of each stock. The Interactive Brokers is 4.6% or 5.6% interest on the margin account. Either way, it's better than my HELOC and much better than Qtrade. IB's metrics are incomprehensible. All I know is I had over 600,000 in stock, was able to borrow 330,000 against it, and was told to keep the excess liquidity in the upper right above 30%. Otherwise, there's the dreaded margin call, kicked off with warning emails, which freaked me out a little bit the first time I got them. All brokers have a margin call. This happens when your stocks go down and you aren't keeping the ratio that they want for their safety. And you can either, one, deposit more cash, as I had to do the one time I was below 30,000 in excess liquidity. Two, you could sell something to generate cash. Or three, they will sell something random for you. Obviously, selling when things have gone down is the wrong thing to do, so you should have cash available. But then, why did you use the margin? That should give you an overview about borrowing to invest. It's a little bit like getting a mortgage for a house, which people don't seem to mind to carry for 25 years. I don't think you want to carry a margin account for 25 years though. So you can borrow for stocks as well. And while it adds to your percentage return as well as total amount returned, it also adds risk. And if you time the market wrong, it will add the wrong type of excitement to your life. So tread lightly. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.